Today on Pitch Fund and Scale, I'm speaking with Maneesh Srivastava, an angel investor, startup mentor, and founder of Alphavalue Ventures. Let's dive a little more into the Alphavalue Consulting and then Alphavalue Ventures. The scale of operations is humongous: 2,000 plus valuation, legal advisory, due diligence. These are complex things that you are doing for established companies as well as for startups. What makes the alpha value approach to valuation and compliance unique? How you're different from other one of your competitors, or what extra value do you bring to the startup founders?
So the question is like I would say this thing like there are valuers who are only valuers. And so when you are being only a valuer, you look from the one perspective of the thing. Like, okay, this is the numbers and this is something, but you don't look from the business side then. But when you being a valuer as well as an investor as well as a mentor, then what you look at like, okay, whether this business will work or not. So you have uh, you are in the game, you are not out of the game, you are not doing something sitting outside the uh, pitch, you are in the pitch. So then you realize that okay, this is over the period of years, like I tell you one brief, like the Paytm company, that the first Excel that being discussed on my laptop. So
Wow.
that is something that being started with. The Snapdeal was our client when like all the rounds that are happening, even when Ratan Tata, Honorable, I would say the Honorable Ratan Tata has invested into it in the Series E round, and that is the time where we have carried the valuation at that point of time. So
Wow.
these are the things that given us the depth of the valuation to understand it more. Uh, it is not only about like what is the number that is. Suppose take example. Suppose a person like Ratan Tata or somebody who being on a very high stature, he is coming and investing into your company. Automatically, the entire ball game changes, and that is
Hmm.
the value that the startup start. That is a traction point that comes into the game. So
Right.
so these are the small things that need to be looked at. It is not only about the money that the person is investing, it is person
Yeah.
who is coming and what is the importance that he hold in the society. That is also very
Absolutely.
relevant, right? So I always look at the perspective. A lot of the valuers, I would not say that anybody is doing a wrong job. Every valuer is doing a good job, first thing first. The only thing is like, if you're doing the valuation based on numbers, then you are not a valuer, you are a calculator. If
Right.
suppose you are going deep into it, understanding the business, understanding what are the challenges of the business. Okay, so I give you an example which will help you to clear it out. Like there are two companies which have the same PNL, same balance sheet, every number dot by dot same, the sectors are also same.
Hmm.
But one company being run by a person who is 75 years of age with no succession planning and no son, no daughter, nothing. And the other company with the same set of numbers being run by three professional founders, 40, 45 years of age, and these are all professional directors. Now, if you say like you value the company based on number terms, you say the value remains the same. But there's a drastic change in the valuation because if something happens to 75 years old guy, what will happen to the company?
Hmm.
So my entire projection, if I look at the way I've been looking at, because this person who's 75 years of age, won all the gold medals, everything doing great in the past, but what is going to the future? So you need to be looking more deeper into it beside the numbers, and that is where the role of the valuer comes into picture. And it is more, and when I started, I tell you, when I started valuation about 18 years back, I felt by going through all the methods that I also being a valuer now.
Hmm.
Then now I feel after 18 years, every valuation is a different valuation. You need to go look into different various parameters. You cannot define it based upon numbers. And that is where the role of the valuer comes. So valuation, when people say it's more of an art than a science, I really appreciate it because It's an art, and art comes from your experience. Art
Right.
is nothing like drawing any picture, but is more, it talks about your experience, and the experience make you understand what is the valuation is. But again,
Right.
I would say, like, a lot of the time people think about like valuation is something the valuer is doing. I don't agree to it. No valuer do the valuation. It is the investor. It is the it actually, frankly speaking, the valuation, there's nothing like a fair valuation. People always talk about it. We write in our report as well that this is the fair valuation of the company. Fair value of the share is this and this. There's nothing like fair until and unless it has gone to the public. It has tested the
Yeah.
water of IPO. It is not. So it is the notional value with a certain set of investors coming together, feeling that this should be the value where we can mint the money by investing at this particular price. So this is the notional value. That has nothing to do with the fair valuation. But because of the regulatory practices, we need to write fair value of the company.
Sure. I completely agree with you on that, Manish, because look at the stock market also. One day your valuation and market cap is at this, and suddenly something happens and you lose 10% of your market cap, bringing the share value to a very different price altogether. So, what changed in one night?
Yes, nothing changed in the balance sheet, nothing changed in the financial statement, but it's the sentiment that has changed.
Yeah, yeah, absolutely. So we will keep the discussion going on valuation, and let's talk about the good, the bad, and the unrealistic. Valuation is one thing which is very close to my heart because I talk to founders on a day-to-day basis, and I understand and see some weird type of analogy and valuations that why I think my valuation is this much. So let's talk about the good, the bad, and the unrealistic. Common myth founders have around valuation.
Common myth, I would say that generally the founders look at like, okay, he's my competitor, and because he has raised the money at this particular valuation, so my valuation should also be the same, or in
Right.
that particular range. But the
Mhm.
question is this: at what stage your competitor is? You should not look at what is the valuation as on date of your comparable company or of your competitor, but you look into like when he was at your scale, what is the value that at which the fundraising has happened to that company? What is the first, when you got the first check at the revenue what you are today, what is the valuation at that date, not at a present date? Okay, a lot of people
Mhm.
get confused, like, okay, this company is raising so much money, I should also get so much of the money. This is one myth, I would say. Second, a lot of people think that I provide a certain projection and the people will believe, and that is the value.
Mhm.
Because one day I sit with my chartered accountant, he will draw certain numbers. Based upon numbers, some value will come. Uh, I don't agree with this thought. The reason being, because when you write certain number, it cannot be the whole punch number that you are just punching the number in the Excel sheet. Those
Right.
numbers should be backed by certain reasons, certain logics. What is the units that you are going to produce? What is the unit matrix that is there? What is the margin in the industry that being there? It is not like you felt like because my value is coming low, let make it better by increasing the margin. It should not be like
Right.
that. You need to look at like whether the industry run on that sense or not. What is the margin of the industry? You cannot exceed or go beyond the margin of the industry. Of course you can, if you being like Elon Musk, or you doing something like on a very different note and you have a lot of money. Okay, but in a normal
Right.
parlance, I would say you need to be a part of the industry.
Sure.
A lot of
Good.
startup comes and says that we are unique, no competitor exists to us. It cannot be, because you need to be a part of the certain system, because at the end of the day consumer is a consumer, and you need to serve the consumer and feed the consumer. So we need to understand that we need to be the part of the system. There will always be there may not be competitors present locally, or maybe in your country, there may be internationally, there may be certain
Right.
competitors that may present. So you need to look at the landscape of the competition that they are not only in India, globally as well.
Right. Money. That is, if a founder says that I we don't have a competition, that means they haven't done their homework in the right order. I'll give you an example of that. even sending people in space on a commercial flight, there is a
Yes.
competition.
Yes.
Amazon is trying to do it. Obviously, Elon Musk is trying to do it.
Virgin
Somebody
is
in
doing
Europe is trying to do
it.
it. So, if that high tech,
The competition.
very there is competition over there also. So how can you say that there is not a competition? I'm building some kind of a SaaS platform or
Wherever
money.
there is money, wherever there is money, there's a competition
Right.
because people are chasing money.
Yeah. Yeah. So now let's talk about the legal ESOP and due diligence essential. So you get a lot of applications and founder reach out to you to help them, guide them, mentor them on these aspects of legal ESOP and due diligence. First, let's talk about why do you think the founders should have the legal hygiene as a moat, that all their legal documents, everything should be in right order. Does it help in fundraising in any way, or do you think it is a exercise that since everybody is doing, you should do it, or it doesn't help at all?
I would say it is the most critical part. The reason being because if something gone wrong on the legal side, any documentation side, then it has its long implications. You cannot go and rectify later on.
Hmm.
And a lot of the time, what is happening, people get connected to early stage, maybe financial advisor who are themselves new to the system, and then they start doing the work of the startup like a traditional company. Okay, where they go wrong. I tell you few
Right.
of the reasons. A lot of the time when you go to the financial consultant, he will say that, okay, you want to form a company, it's better you go with LLP rather than a company.
Right. Understood.
No, a founder does not know like what is right, what is wrong. He says that, okay, less complication, go with LLP. Now, when he
Mhm.
goes to the LLP, then later on, you cannot raise funds in an LLP because the LLP cannot issue shares. And when the LLP cannot issue shares, you cannot invite the investors into it. So we need to be very clear, like at the very starting point, who is my advisor, who is helping me out, and then uh, it is always being better because he will not only provide you the advice which you wanting to, but he also provide you certain advices which you are not knowing to.
Understood. Understood. So well said. Manish, if you have some kind of a checklist that you remember, can you take us through a basic checklist that every startup founder must have before uh, even thinking of fundraising? What are those checklists? Obviously, they have to have a pitch deck. So that is the number one. Company talk. Do you think there is 5 or 6 items that they must have before going for a fundraising?
Yeah, before going to the fundraising, they need to be very clear with regard to, yes, of course, because it's a company, they already have the MOA, the AOA, and all these things. But beside this, there need to be few critical aspects because when you start a company, you don't think on a very longer horizon. You say that, okay, we are two friends, let's start a company, build a company, you get it registered. There, 90% of the companies don't have the founders agreement.
Wow.
Now, later on, when one person is doing hard work, the other person is not doing it, then it start hurting, and then the relationship becomes sour.
Mhm.
So, founders agreement is one of the important critical thing that need to be clear cut roadmap. There need to be an exit clause as well. Maybe today I've been acting as a co-founder, working along with you, feeling very good, but later on I have the other opportunities that being available. Then I start thinking differently, and then what will happen? There need to be an exit clause as well. Like there need to be a buyback of shares by one party to the other, or there can be an exit clause because nobody thinks of those lines because they are starting it. Everything is very positive side, so everybody talks about on the positive note. So these are the few areas. Then as well as you need to have very hygiene cap table.
Mhm.
When you say like you started a company, then you need to have a separate account because the company is a separate entity. You should
Right.
not make expenses out of your personal account. A
Right.
lot of the time when we talk, we say they say that I have given a salary from my personal account. So there need to be a very clear cut demarcation between your personal account and between what is the company account is. Okay. Then another aspect, a lot of the time, uh, people are making, I will not go deep because that is more on the finance side, I would say. But a lot of the time, people, uh, the, the capital expenditure, they represent it as an expenditure, as an expense, and hit the P&L statement. And because of that, the profitability goes down,
Mhm.
and it need not to be, it need to be capitalized over the period of years. And that is, I suppose, my company is into like running cars, and I purchased cars and booked in my P&L, and all the expenses booked as an expense. The entire my P&L will go down, my profitability go down. So I need to look at what are the capitalized item, what are the non-capitalized item. So I will not go deeper into it, but these are the certain
Sure.
things that to be clear. So for this, the founder is running his show. He does not know all these implications. So he need to have a very strong person who knows the finance, who make him understand what is need to be presented, what are the gray areas that been there. So that will be very helpful. So one finance guy and one legal guy, and if we can be a mixture of the two together, then it is very good.
Great. Good. Thank you, Manish, for that. Let's talk about the talent for a startup founder and a startup company. How talent is important, and to attract the talent, ESOP is very, very important. Can you give us a 30,000 feet view of the ESOP structure that a early stage startup founder should have to attract good talent in their company?
Okay. So first thing first, like if you are a company and willing to raise funds in the future, it is very important that you should have the employee stock option policy in place. Because suppose the investor invested the money, and after investing, you are saying that I am thinking to opening a ESOP pool account, and from which I will be offering to the employees a discounted price shares. Then the investor will say that, boss, it is the dilution of my money, first thing first.
Yeah.
So it should not be. So before like going for the investor, a person need to have the employee stock option account, because he has to retain the talent. And
Right.
like when you're starting, you don't have so much of the cash to burn. And so the compensation package should be like you will be getting this much amount as cash, and the other component of your salary will be the employee stock options. These options will not be like on the day one provided to you. It will be vested over a period of time, and over a vesting period you'll be getting the employee stock option. So when suppose it goes like this, suppose 100 options need to be given. So on the first year I provide suppose 30%, next year I provide suppose 40%, and the balance 30% I provide in the last year. So when the person will be when the employee will be working for the company, he will be with the company because he wanted to have the options to be getting converted into equity. Okay. So when options are just being a right, these are not equity shares. These are equity shares a person will get when he will complete the vesting schedule, and when he get the right to exercise those options.
I see.
Okay.
Okay.
So
Okay.
so this being critical, and I would say that basically this employee stock option is started majorly from the tech companies, because
Mhm.
uh, if you want to hire a techie guy, you need to pay a handsome remuneration. But as a startup, you don't have, so it is the employee stock option that you need to provide.
Mhm.
So this is the only way to attract the talent. Suppose I, being a deep tech company, I will get into revenue line 5 years down the line. So now, how to get him rolling? How to attract him? So it is the way to attract the talent through an employee stock option. That's a retainer strategy, I would say.
One founder you wish you had invested in?
I wish I would have invested in a company called India Mart, which is very next to my building. And this company, I've been providing a consulting and evaluation from the last, like I would say, 15 years. And but I miss the train when I have to invest, and this is a regret I would have, because this IPO opens at 10,000 rupees market price,
Mhm.
and
Wow.
this share was available to me at 300 rupees, and but I missed that.
Okay. Legal or valuation, what kills more deals?
Uh, Valuation is always being negotiable. I would not say it kills deals, but if times at times when the founder is very adamant on the valuation, then of course it hurts and it kills. But legal, yes, at times a person able to get a soft commitment, but because of certain legal challenges, legal problem, documentation on the legal due diligence side, it fails, and that hurts more. So after even getting a soft commitment, it's not like it will get converted into actual investment. So again, the legal thing need to be taken well care of and well safeguarded. That I would say. Valuation, that being more negotiable, I would say. Whatsoever
Sure.
the valuation is, if suppose you really need the money, you can always come down. But if you being at a certain level, then you feel like, okay, I can command the valuation, so you command it.
Okay, got it. Uh, Indian startup ecosystem is growing very, very fast. We are number three right now, I believe, in the
Yes.
world. Equity or debt, which is the preferred vehicle to raise funds in India?
This is a very good question, I would say, and a lot of the founders are making a lot of mistakes in this, because like when to raise the money, that is one question, but what is the medium from which to raise the money? Whether it should be equity, whether it should be debt. First thing, like go with the equity, of course, because you cannot get debt because there is no balance sheet of yours, so you require an equity. But once you get the equity from the AIF fund or any of the fund houses that you get the equity, then try to get the debt. And there are, I was also not aware, but I came to know there are so many channels that being available for the debt funding, right? There are
Mhm.
revenue funding as well. Okay, so the question is, I am not going to dilute my stake. I am getting the fuel to run for a certain extra miles, but I'm not diluting my stake. So let's create and go to the level where I can then command the next level valuation. So this is very important, as well as the government is also, I would say, helping the startup to invest into them on a 50-50% basis. Like
Mhm.
if you're willing to raise 50% equity, 50% in the format of the CCD, compulsory convertible debenture, the government is providing to it. There's a technical development board. There are so many other government agencies. There's a MIT who is providing the
Mhm.
investment. So now the government is also looking at like we don't ready to part of it too much of the grant. We also want to be the part of it, part of the startup ecosystem. So they are now providing more in the format of the CCD. So grant is a limited amount, and
Mhm.
then the CCD is where on the actual valuation basis they invest into it.
I see. Okay. Okay. Manish, last question for this podcast or videocast. What is your one-liner advice to the every founder or early stage founder who is listening today?
I would say that do a lot of research, and without doing a research, without analyzing the gap, don't do anything. Otherwise, you will be wasting your resource, energy, time, and everything. So get the right mentors on board, who has already seen the market, who has already understand it, and then he can always help you, guide you. So this I believe that should be the part of.